The term financial derivatives have been attributed to some of the major corporate and economic events happened in the recent past, especially the events which had a disastrous consequence on the economy. Some of those events are the bankruptcy or the near bankruptcies of institutions like Barings Bank in 1995, Long-Term Capital Management in 1998, Enron in 2001, Lehman Brothers and American International Group in 2008, and the reasons for their failure have been attributed to financial derivatives. And the failure of these institutions had a major consequences, a disastrous consequence on the world economy. And that's the reason why financial derivatives have been sometimes referred as the economic weapons of mass destruction. Does it mean that derivatives are the worst thing to happen in financial market? Not really. Because of all these instances, there were books written on it and millions made. So at least those people won't say so. On that note, let's try to understand what is a financial derivative. A financial derivative is a contract between two counterparties to exchange a particular quantity of an asset on a future date at a mutually agreed price. So the important attributes of this contract is that it has a quantity mentioned in that, and there is also a agreed price, and they are exchanging the asset on a future date. And this is the cardinal difference between a financial derivative or a derivative transaction and a normal transaction. In a normal transaction, the buyer and the seller agree on the price today, and they will exchange the asset also on the same day, same time. But in financial derivative or a derivative transaction, the buyer and seller agree to exchange the asset today, which is referred as a transaction date, and they will exchange the asset and the cash on a future day, which is referred as a settlement date. And now the asset which is mentioned in the contract, it can be a equity share, or it can be a commodity like crude oil, gold, or it can be even a soft commodity like wheat or sugar. It can be a currency, it can be a stock index, or it can be an index in interest as well. Now let's consider two companies, ABC Limited and XYZ Limited. ABC Limited is a coal mining company and XYZ Limited is a thermal power generation company. They use coal to produce electricity. These two companies have got a business model and they have a profit margin to protect. The major influencer of that particular profit margin is the market price of coal. If the market price of coal goes down, that will affect the profit margin of ABC Limited, which is a coal miner. On the other hand, if the market price of coal goes up, that will increase the cost of production of electricity produced by XYZ Limited, and that will in turn affect their profit margin. So in this dynamic situation, how can these two companies protect their profit margin? So in order to protect their profit margin, these two companies have decided to get into a contract. And the contract says exchange 10 tons of coal at rupees 2,500 per ton on March 31st. Here we are assuming that March 31st is a future date and 10 tons is more than enough for XYZ Limited to run their power generation activity for the rest of the year. So by getting into a contract like this, they are insulating themselves from the price fluctuations of coal in the market. And this is the simplest form of a derivative contract, and you can call this contract as a forward contract. And in this contract, ABC Limited is the seller and XYZ Limited is the buyer in the contract. And whatever happens to the coal price, market price of coal on March 31st, ABC Limited exchange 10 tons of coal to XYZ Limited, and XYZ Limited pays 25,000 rupees in cash, which is the price which is mentioned there in the contract. So the market price of coal is not going to affect this transaction. And with this contraction, both ABC Limited and XYZ Limited can protect their profit margin. Here, the important thing that we need to notice here, the interest of both these companies on coal price are opposite in nature, which means that ABC Limited is affected if the coal price falls and XYZ Limited is affected when the coal price goes up. So which means that for a forward contract to happen, you need to have two entities who have got opposite interest on the asset price. Otherwise, you cannot have this particular forward contract. So for example, if both ABC Limited and XYZ Limited are affected similarly, if the coal price goes up or go down, then you cannot have this forward contract. Now let's consider two individuals and let's call them Tom and Harry. Tom and Harry are experts on coal price and they have got a view on the price movement of coal by March 31st. Tom is expecting the coal prices to go down by March 31st and Harry is expecting the coal prices to go up by March 31st. And now they want to make a profit based on their price expectation. So how can they achieve their objective? All they have to do is to get into a similar contract like this. Since Tom is expecting the coal prices to go down, he assumes the role of a seller in the contract. On the other hand, Harry, who is expecting the coal prices to go up, he will assume the role of a buyer in the contract. And now let's see what happens on March 31st. Let's assume a scenario. On March 31st, the coal price has gone up by 2,600 per ton. Here, Harry's position came to be right. So for Tom to settle this contract, he has to buy 10 tons of coal from market at 2,600 per ton and deliver it to Harry at 2,500 per ton. And in that process, he incur a loss of 100 rupees per ton, and his total loss is going to be 1,000 rupees. On the other hand, Harry, who have bought 10 tons of coal from Tom at 2,500 rupees per ton, he can sell this coal in the market at 2,600 per ton, which is the market price. So in that process, he will make a profit of 100 rupees per ton, and his total profit is going to be 1,000 rupees. Now the question here is, why would Tom and Harry take the headache of buying coal from the market, delivering it, and again selling it back in the market? Because Tom does not mine coal, and Harry, who he doesn't use coal to produce electricity, they don't have any underlying interest on the coal. Their original objective was to simply make a profit based on the price movement of the coal. If that is what their objective, in order to settle their contract, the best way they can do is Tom, who is the losing party, passes his loss to Harry. So Tom pays 1,000 rupees to Harry to settle the contract. In that way, they can avoid the headache of buying coal in the market, delivering it, and then again selling it back in the contract. Now let's take another scenario. By March 31st, coal price have gone down to 2,450, which is a fall of 50 rupees per ton. Here, Tom's view on the price movement of coal came to be right. So Harry's position is losing. So to settle the contract, Harry has to pay Tom the difference between the market price on March 31st and the price mentioned in the contract, multiplied by the quantity mentioned in the contract. So Harry has to pay 500 rupees to Tom to settle the contract. So here, for Tom and Harry to get into the forward contract, they need to have a opposite view on the price movement of the asset, underlying asset. Now we have seen two ways of settling a forward contract, one between ABC Limited and XYZ Limited. They have settled the contract by actually exchanging the call, actually exchanging the underlying asset which is mentioned there in the contract. So when you settle a forward contract in this way, you call it as a delivery settlement. On the other hand, Tom and Harry, for settling the contract, they simply exchanged the difference between the market price and the price mentioned in the contract multiplied by the quantity. Depends upon whose position is winning. So they are just exchanging cash alone. So when you settle a forward contract in that way, you call it as a cash settlement. Now, the intention of ABC Limited and XYZ Limited to get into this particular contract was to protect their business interest or protect their profit margin. And they have got an underlying interest on the asset mentioned in the contract, which is core. So when you two entities get into a contract with the intention of protecting their business interest, they were called hedgers in the market. But Tom and Harry, they don't have any underlying interest in the asset on call. Their only objective was to make profit based on the price movement of call. So when entities get into a forward contract with the intention of making a profit without having an underlying interest on the asset mentioned in the contract, they were referred as speculators in the market. Now, in a market space, you can have contract signed between a hedger and a speculator. So when that happens, what really happens is the risk in the market is getting shifted from the hedger to the speculator. So hedger originally wants protection against the price fluctuation, and the speculator who wants to make a profit based on the price movement of the asset. So in derivative market, it can satisfy the objective of both the entities. And this is the beauty of a derivative market, and with the participation of speculators, speculators can provide that required liquidity to the derivatives market. And let's consider the two speculators: Tom, who is the seller of the contract, Harry, who is the buyer of the contract, and they have this contract which says exchange 10 tons of gold at 22,500 rupees per ton on March 31st. So what happens? Either one of these parties or the losing parties goes absconding without fulfilling their obligation on the contract. Then the very purpose of having this particular contract is defeated. So it is a situation that both Tom and Harry wants to avoid. For that, what they have decided to do is they have decided to appoint a mediator. A mediator, an honest person whom they can trust. And an honest person is always a child. That's what Socrates has said. So they have appointed an honest person to mediate between them. But that does not solve the problem. Still, either one of them can go absconding on March 31st. If that is the case, then the responsibility of fulfilling the obligation on the contract falls on the honest person. And he cannot go absconding because he has got a reputation to keep. So how he can address this issue? The honest person is not just an honest person, he is a smart person too. So before getting into the contract, he will demand both Tom and Harry to place a security with him. And that security will be in the form of a deposit valuing the total value of the contract. So Tom and Harry will place 25,000 rupees, which is the value mentioned in the contract, with the honest person to transact in this forward contract. And now let's see what happens on March 31st, and we are considering the first scenario. On March 31st, the gold price has gone up to 2,600 rupees. Here, Harry's position is winning. Who is Harry? Who is the buyer? His position is winning. So Tom has to compensate him. So Tom has to compensate him with 1,000 rupees, which is the difference between the market price and the price mentioned in the contract multiplied by the quantity. So here the mediator can take money from Tom's account and pay 1,000 rupees to Harry. So he will give 26,000 rupees to Harry on expiry of the contract, and he will return 24,000 rupees to Tom. On the other hand, if the price of coal falls down to 2,450, as in the second scenario, here Tom's position is winning. So Harry has to compensate him with rupees 500. So mediator will pay 500 rupees to Tom's account by debiting Harry's account. So mediator will pay 24,500 rupees to Harry and 25,500 rupees to Tom at the end of the contract. So this is the way a mediator settles a forward contract. And mediation in a derivative market is not a child's play. So the role of a mediator is normally played by an exchange. So when a forward contract transacted in the exchange, it is called a futures contract. So the difference between a futures contract and a forward contract is a forward contract is more of an OTC product or over the counter product, which means that the buyer and seller directly deals with the forward contract in the forward contract. On the other hand, a futures contract is an exchange traded product. A forward contract can be customized, which means that the buyer and seller can decide whatever quantity they want and mention it in the contract. So they also can decide on the expiry of the contract. But when it comes to a futures contract, since it is traded in the exchange, it is the exchange who decides the terms of the contract. So exchange decides or specify terms like the quantity in the contract. So the exchange specify the quantity with respect to a lot size, and the exchange will also specify the expiry of the contract. To understand this, let's go to the National Stock Exchange website and let's take a futures contract on Infosys. So here you can see that there is something called market lot mentioned, market lot 500. What it means is that one futures contract of Infosys Limited contains 500 Infosys share. So that's the quantity specified by the exchange. So if somebody wants to buy or sell one Infosys futures contract, the total value of the contract will be the market lot, the 500, multiplied by the market price. And the exchange also specifies the expiry of the contract. And in a given point in time, the exchange offers three different contract with three different expiries, one expiring in the current month and the other one expiring in the next month, and one contract expiring the month after that, which is referred as a 4-month contract. And we have seen that a forward contract can be settled both delivery based and cash based. But your futures can only be cash settled. Now let's see how a derivative contract is transacted in the exchange. So Tom, who is the seller in the futures contract, and Harry is the buyer in the futures contract, and they have decided to transact in ABC Limited share when the share price is at rupees 1,000, and the exchange specified lot size is 500, and the number of contract is 2. They have decided to transact in 2 contracts, and the expiry of the contract is 3 months. So the total value of the contract is the quantity is 500 multiplied by 2,000 multiplied by 1,000. That is the price of the ABC Limited share on the day of transaction. So the total value is going to be 10 lakh. So as per our previous example, both Tom and Harry needs to deposit 10 lakh rupees each with the exchange to transact in the contract. But you can see that 10 lakh is a fairly higher amount. If the exchange fixes the price to participate in the futures contract at 10 lakh rupees, not many people would be able to participate in that. So that is something which will affect the liquidity of this particular contract. So in that case, what the exchange will do is like exchange will only take something called an initial margin from the counterparties. And here we are assuming that the initial margin specified by the exchange is 60%, which means that both the seller and the buyer in the futures contract, they can pay the initial margin to the exchange through their brokers to initiate this particular futures contract. So both Tom and Harry pays 6 lakh rupees each to get into this particular futures contract. And now let's consider a scenario wherein on the day of expiry, the price of ABC Limited has fallen to 300 rupees. Yes, it was a steep fall in the share price. So if this is the scenario, in order to settle the contract, the, lo the losing party the losing party here is Harry because he is the buyer in the futures contract. Difference between the market price on the expiry and the price which is mentioned there in the contract, which is 700 multiplied by the quantity, which is 1000. So Harry has to make a payout of 7 lakh rupees to settle this particular contract. But the problem here is Harry's margin account does not have 7 lakh rupees. He is short of 1 lakh rupees. So who will bear this additional expense of 1 lakh rupees? And this is a potential risk the exchange has to face in an extreme market situations like this. So how will the exchange address this particular problem? For this, the exchange will fix something called a maintenance margin at the inception of the contract itself. Maintenance margin is a benchmark fixed by the exchange at the beginning of the contract itself, and we are assuming that the maintenance margin fixed by the exchange in this case is 50% of the contract value. So the amount is going to be 5 lakh. What it means is that both the counterparties should have at least the maintenance margin 5 lakh rupees in their margin account throughout the life of this particular contract. And besides this, the exchange will not wait till the end of the contract expiry period to settle the contract. They will settle the contract on a daily basis based on the closing market price of ABC Limited shares. And this is called daily mark-to-market settlement. Now let's see how does the daily mark-to-market settlement work. So you have the exchange, you have Tom here. Tom is the seller in the contract. He has taken a short position in the futures contract, and Harry is the buyer. Harry has taken the long position in the futures contract. So on day one, when they go to this particular futures contract, the price of ABC Limited was 1000 rupees. So they have paid the initial margin of 60%, that is 6 lakh rupees to the exchange through their broker to initiate the futures contract on ABC Limited. And on the exchange also has fixed the maintenance margin at 5 lakh rupees, the 50% of the total value of the contract. And on day two, the share price of ABC Limited has gone up to 1010. So here for settling the contract on a daily basis, here the share price have gone up, which means that the buyer's position is winning. So Harry's margin account needs to be credited with the difference between the market price and the contract price, and multiplied by the total quantity, which is 1000. So the 10,000 rupees is which need to be credited into Harry's margin account. So the exchange will debit Tom's margin account, Tom who is the seller, his margin account, and credit the amount to Harry. So the balance in Harry's margin account right now is 6,10,000 rupees, and in Tom's margin account has become 5,90,000 rupees. On day 3, the share price have become 1015, so which is an appreciation of 5 rupees. Again, the direction of cash flow is towards the buyer side, since the market price have gone up. So the amount to be settled is the difference between the day 3 closing price and day 2 closing price, so which is 5 rupees. So the exchange will again debit the seller's margin account by 5,000 rupees and credit the amount in buyer's margin account. So now the margin account of buyer is showing a balance of 6,15,000 and seller's margin account is showing a balance of 5,85,000. Now the good days in market will not continue forever. On day 4, the market has fallen. The closing price on day 4 of ABC Limited is 990 rupees, which is a correction of 25 rupees. Here the market has come down, which means that the person who has taken a short position, his account needs to be credited with the difference in the amount. So the difference in the amount between day 4 closing price and day 3 closing price is 25. Total value of contract is 1,000. So the amount to be settled is 25,000 rupees. So the seller's margin account will be credited with 25,000 rupees and his margin account balance has become 6,10,000 rupees. The buyer's margin account will be debited by 25,000 rupees and his margin account has become 5,90,000 rupees. On day 5, again the share price is going down and the closing price is 880 rupees, which is a correction of 110 rupees, which is a steep fall. So, and the direction of cash flow is from the buyer's side to the seller's side, and the total value to be settled is 110 rupees multiplied by the quantity in the contract, which is 1,000. So the total money to be settled is 1,10,000 rupees. So Tom's account will be credited with 1,10,000 rupees and his margin account is showing a balance of 7,20,000 rupees. And Harry, who is the buyer in the futures contract, his account will be debited with 1,10,000 rupees and his balance has become 4,80,000 rupees. Here the balance of the margin account of Harry has fallen below the maintenance margin specified by the exchange. So at this point in time, Harry has to bring in additional money to continue in the contract. And the amount, so the Harry has to bring in an additional margin, and the amount of money Harry needs to bring in is with which he should be able to take his margin account balance to the original initial margin fixed by the exchange, which is 6 lakh. So the amount is going to be 1,20,000 rupees. So Harry, for him to continue in the futures contract, he has to bring in additional margin of 1,20,000 rupees. So this is the cash flow in the futures account, which happens in both the buyers and sellers account. So the exchange will settle the margin account on a day-to-day basis based on the daily closing price. So this is how a futures contract account work in an actual scenario. Now let's consider, why would a speculator consider investing in a futures market instead of cash market? So let's take the two scenarios. Somebody investing in cash market. So they are buying ABC Limited share 1,000 quantities when the share price is 1,000. So the amount invested is 10 lakh. And let's say after 3 months, ABC Limited share price has become 1,100. So the investment value has become 11 lakh. And the profit here is 1 lakh. And which is a 10% appreciation on the original invested amount. Now let's consider the same scenario in the futures market. So in order to make the total value of the contract equal to 10 lakh, the speculator is investing in two futures contract. He's buying two futures contract of ABC Limited, which has got a lot size of 500 rupees. So the total value of the contract is 10 lakh. And we know that for investing in futures contract, you don't have to invest the entire value. You only need to invest or the initial margin specified by the exchange, which is in this case is 6 lakh rupees. Okay, yeah, and then after 3 months, ABC Limited share price have become 1100. So the investor, the speculator, is long on futures contract, so which means that his futures contract margin account will get credited with 1 lakh rupee, so his margin account will become 7 lakh. And this is also a profit of 1 lakh rupees, but this 1 lakh rupees profit is made by investing only 6 lakh rupees. So the percentage of profit is 16.67 percentage. So it is for this high margin that speculators invest in futures market instead of cash market. So it is for this leverage that speculators bet on futures contract instead of buying shares with cash. And we know that in a derivative market you have both speculators as well as a hedger. Now, how will a hedger use a futures contract to protect his business interest? For that, let's consider a mutual fund manager. The mutual fund manager has invested in ABC Limited shares. He has bought ABC Limited shares worth 10 lakh rupees. But ABC Limited is going through a turmoil. There is some rumor in the market that ABC Limited might lose some major client. So if ABC Limited lose this client, it will affect their future cash flows. On the other hand, if ABC Limited is able to retain the client, the company will continue the stellar performance. So during this phase of uncertainty, the ABC Limited share is highly volatile, and the mutual fund managed by the fund manager is an open-ended fund, which means that investors can come in and get out of the fund anytime that they want. So when they enter and exit the fund, the net asset value or the NAV of the fund is getting affected because of the high volatility of ABC Limited shares. So in this scenario, how can the fund manager protect the interest of the investor by studying the NAV? For that, what the fund manager has to do is like he has to short ABC Limited futures worth rupees 10 lakh, the value which is equivalent to his long position, by paying the required margin. So the fund manager taken a short position in futures contract. The value of the contract is 10 lakh. Now let's consider a scenario in which the ABC Limited share price is going down by 10%. So when the share price get corrected by 10%, the value of ABC Limited in the portfolio will become 9 lakh. But since the fund manager has shorted the futures contract, his margin account will get credited with 1 lakh rupees. So together with the margin account balance, the total value in the portfolio will be 10 lakh. So a fall in the share price of ABC Limited has not affected the total value of the portfolio, so the NAV will be steady. And on the other hand, if the market price of ABC Limited is going up, let's say the market price is going up by 10%, then value of ABC Limited in the portfolio will become 11 lakh. But the fund manager's margin account will get debited with 1 lakh rupees because he has shorted the ABC Limited's futures contract. So again, together with the value in the balance in the margin account, the total value of ABC Limited in the portfolio is 10 lakh. Since the total value in the portfolio is 10 lakh, the NAV of the fund is not affected. So this way, the mutual fund manager can protect the wealth of his investors when a particular share become highly volatile due to some market news. With this, you can see that derivative is a very innocent product, and it is the people who deal in derivative makes it a weapon of mass destruction. Thank you so much for listening. As always, please subscribe to the channel and like the video as well. Thank you so much.